Good morning. Mark Ostwald from ADM ISI with some thoughts on the US-China trade war and its impact on both actual trade and indeed financial markets of late. We've had some useful charts provided by the IMF recently to show what's actually been happening. And I think the point here really is that we haven't actually had that there has been a very, very clear impact, but this is going to go a whole load worse if we actually scale up this trade war. So what we can see on this particular chart, the first chart is US imports of goods from China, which have fallen quite significantly as a result of the tariffs. One can see that it's got progressively worse with each measure, and one can also see that after the first round, which didn't really prompt much stockpiling, in the case of when the other ones were the 200 billion and indeed the 16 billion, there have been little spikes that we see beforehand as people try to stockpile to avoid the tariffs as they're coming in. But clearly, imports have fallen quite from China have fallen quite substantially, though one would also have to add that in the context of the broader US trade deficit with China, thus far the impact has been actually quite small, though overall we have seen a reduction in the bilateral trade deficit between the US and China since the imposition of the 200 billion at the end of last year. Which has narrowed the trade deficit to about 20 billion. That's the impact of US tariffs on Chinese goods. Let's look at the reverse side of the equation and see the impact of Chinese retaliatory tariffs on US goods. And as one can see there has been an impact, but it's not quite as marked, which tends to sort of highlight a given point. And which makes the whole technology focus that we are now gradually getting with Huawei and a number of other suppliers who are expected, who are deemed to be a security threat, that actually there's been less impact in the longer run, and that actually some of the imports from Chinese goods have actually recovered. In a number of cases, obviously, there's one would suspect that this is also to do with agricultural problems that China has, i.e., above all, to do with Asian swine fever, whereby any tariffs that they do impose at the end of the day, they can't avoid, because if they actually have to import to rebuild their stock of pigs or stock of swine, then it doesn't really matter whether the tariffs are there or not. Right. Now, obviously, the most marked impact that we can see is on the next chart, and that has been on US dollar against the Chinese yuan. That particularly took a sharp downturn for the yuan as a result of the breakdown in the talks at the beginning of May, though that seems to have tailed off of late. And I think the next chart is it's instructive, because it really tells us that a lot of that depreciation of the yuan was actually related to stock market flows. So what one can see on this chart is the flow on the China-Hong Kong Connect equity flows. One can see huge inflows at the beginning of the year as it was announced that China would be included in the MSCI Emerging Market Index, getting a lot of funds to pile in. And then as the trade talks started to break down, so we have seen substantial outflows. And I would suggest that it's less a case that China's trying to devalue the yuan and more a case of these outflows being the major impact on the yuan. So the real question then becomes, if those outflows start to ebb, then will the Chinese yuan stabilize, above all with help from the People's Bank of China to stabilize it?